Welcome back, Focus Learners, to another explainer. Okay, I want to start right off the bat with a question that honestly baffles even the most seasoned entrepreneurs. How is it that a business with booming sales, incredible products, and literally sky-high market demand can still just suddenly die? It happens way more often than you think, and the culprit? Well, it usually isn't a lack of willing customers, it's a lack of flow. So today, we're going to explore exactly why that happens.
To diagnose this, we're basically going to run a biological checkup on your business. We'll look at the lifeblood itself, the anatomy of working capital, fixed versus variable capital, the factors impacting your capital, and finally, the operating cycle.
Section 1. The lifeblood of business. Why cash flow is your company's actual pulse.
Our source material poses this really profound idea. It says, working capital plays the exact same role in a business as the heart does in the human body. Working capital funds are generated, and then those funds are circulated. The absolute crucial takeaway here is that the moment this circulation stops, the business becomes completely lifeless. It's not just about having a bunch of money sitting around in an account somewhere. It's about that money continuously and actively moving.
So let's define the concept a bit more practically. Working capital is the circulating capital required to meet day-to-day operations. I want you to frame this in your mind as the daily oxygen needed for survival. This is the cash you're relying on to purchase raw materials, pay salaries, wages, rent, and, run your advertising. Without this circulating capital, those daily operations just immediately suffocate.
All right, moving to Section 2, the anatomy of working capital, where we dissect the balance sheet. The balance sheet is kind of beautifully binary. On one side, you've got your current assets. Think of short-lived resources like cash or inventory that pump right into your system. Their defining characteristic is a short lifespan, usually less than 12 months, and a really swift transformation into other forms of assets. Contrast that with your current liabilities. These are your obligations that are expected to mature for payment within a single accounting cycle. Essentially, we're contrasting the assets pumping into your system against the liabilities draining right out of it.
So, current liabilities, things like bank overdrafts, outstanding expenses, and creditors, which are the sellers you bought raw materials from on credit, these naturally pull against your current assets. And those current assets are your cash in hand, raw materials, work in progress, finished goods, and accounts receivable. At any given moment, both of these forces exist in the business, flowing around and around like an electric current.
When we analyze this anatomy, we generally start with gross working capital. This is the quantitative view. It's the sheer total size of the current assets you're pumping into your operations. Basically, if you just want to measure the total extent of the current assets you're using to operate your firm, you look at your gross working capital.
But net working capital is the true qualitative pulse check. It evaluates your actual liquidity position. It asks a really vital question. If all your immediate liabilities were paid off today, right now, what assets would actually be left over?
And this brings us to the crucial point. What happens when the math goes the wrong way? Negative working capital occurs when current liabilities completely exceed current assets. Guys, this is an absolute crisis. It means your obligations are draining your resources way faster than your assets can replenish them. In real-world terms, it means you literally cannot pay your employees their salaries this Friday. There's no way around it.
Section 3. Fixed versus variable capital. Let's take the pulse over time.
Think about it like this. A human body needs a baseline amount of blood constantly circulating just to stay alive, right? In business, we call this permanent working capital. It represents the absolute minimum continuous current assets required at all times just to carry out a baseline level of business activities. But when a body engages in a heavy workout, it needs extra circulation. That is your temporary working capital. It's the fluctuating, additional assets needed for peak periods. For instance, you need to maintain extra inventory to support a massive surge during a holiday sales season. Then, when the peak passes, that temporary capital requirement naturally decreases.
Okay, Section 4. Factors impacting your capital, the environmental and genetic forces acting on your business. First, I want to pose this really crucial question to you. What external forces are draining your capital? We spend so much time obsessing over the internal metrics of a business that we honestly often forget about the environmental forces actively pulling cash out of the system. Let's look at what those actually are.
Now, your internal genetics definitely set the baseline. The nature and size of your business obviously play a role, but it's really your firm's policies that dictate flow. For example, if you adopt a strict credit policy with short payment windows, you naturally require less working capital because your cash just comes back to you faster. Plus, if management follows a conservative dividend policy, meaning they retain profits rather than handing out high cash dividends, it naturally strengthens the working capital position by keeping the lifeblood inside the company.
But then we have the external, environmental factors. These are the forces you just have to react to. Business fluctuations, like a sudden economic downturn, will see your sales decline while your cash is just sitting there tied up in inventory. Or consider taxation policy. If the government implements a regressive taxation policy with heavy tax burdens, it aggressively drains your cash reserves, leaving very little profit for you to retain. You absolutely must proactively manage your working capital so you can survive these kinds of external shocks.
Finally, Section 5, the operating cycle, the true EKG of your business. We define the operating cycle as the total time gap between the purchase of raw materials and the eventual receipt of cash from your debtors. It's the literal measurement of how fast your capital completes one full circulation through the entire business.
Let's just follow a single dollar as it transforms through these steps. You start with cash, which you convert into raw materials. Those materials enter the manufacturing cycle and become work in process, which are then converted into finished products. Awesome! You make a sale. But if it's a credit sale, time passes before you actually realize the cash from your debtors. Meanwhile, running concurrently with all of this is the credit period allowed to you by your suppliers. This whole process is just a continuous, cyclically flowing stream.
To calculate this heartbeats precisely, we can use some specific formula variables derived from our sources. And don't worry, we won't get bogged down in dense accounting jargon here. We have M, which is for the time materials are consumed in stock, W, for the time goods spend as work in process, F, for the finished goods inventory period, D, for the average collection period from your debtors, and finally, C, for the credit period allowed by your suppliers.
And what's actually really fascinating here is the final formula. Your operating cycle equals M plus W plus F plus D minus C. By subtracting C, that credit period allowed by your suppliers, you find your true operating cycle. Just think about that for a second. If your suppliers give you longer to pay for raw materials, it actually reduces your operating cycle. It means your own cash is tied up for a shorter period, effectively speeding up your financial heartbeat and easing the pressure on your internal resources. It's brilliant.
Which brings us to the end of our checkup today. I want to leave you with this final provocative thought. Is your business's lifeblood flowing, or is it stalling? Answering that requires looking way past your sales numbers. Apply this checkup to your own ventures. Look at your gross and net assets, anticipate your permanent versus temporary needs, and calculate that operating cycle. Mastering your working capital ensures that when your business wants to run a marathon, its heart is actually strong enough to keep up. Thanks for joining me on this explainer, and as always, keep learning.